Welcome, everyone. Thank you for joining us for the webcast, Navigating the Affordable Care Act, sponsored today by EPAY Systems. Before we begin, I would like to remind you that this webcast has been pre-approved for IHR certification credits, 1 HRCI webcast for certification credit, 1 HRCI learning credit, SHRM credits, and World at Work credits. Please be sure to attend the complete webcast to receive your credits. You will receive an email from HR.com within 1 to 2 business days, which will include the certification credit information. Questions may be submitted anytime during the webcast by typing the question in the Ask a Question text field and clicking Submit, the orange button located on your screen. And I will now turn it over to today's moderator, Michelle Lanter-Smith.
Thanks, Kathy. Welcome, everyone. Again, my name is Michelle Lanter-Smith. I'm the Chief Marketing Officer here at EPAY Systems, and we're very proud to present Navigating the Affordable Care Act with Seyfarth Shaw. Today we're going to talk about some of the takeaways from year 1 in the annual reporting and best practices for year 2 and going forward. For the past 3 years, EPAY has partnered with Seyfarth Shaw. It's our go-to law firm for helping employers, our clients, avoid wage and hour litigation, government investigations, and enforcement actions. Together, we deliver informative, top-of-mind content like today's topic on the Affordable Care Act. We've recently presented other webinars, such as the new Department of Labor overtime rules, and coming up later this year, we'll be back with topics like the new proposed EEO changes and other common HR and legislative trouble spots that we all need to continue to learn about. Just visit epaysystems.com for more information on our upcoming webinars and some of our free ebook offers that can really give you informative information. Today, speaking on the Affordable Care Act, I'm excited to introduce to you our speaker, Ben Conley. Ben is a partner in the Chicago office at Seyfarth Shaw. He is a member of the firm's healthcare reform team, and Ben started closely following healthcare reform well before it passed into law. Ben regularly consults with governmental agencies on healthcare reform developments and has presented extensively on healthcare reform and what it means for businesses, including leading the healthcare reform certification program offered by the Employer Healthcare Congress. He and his colleagues regularly consult with the Affordable Care Act practice leaders here at EPAY Systems, continually improving EPAY's Affordable Care Act service offering, including compliance adherence. Welcome so much. Welcome, Ben. Thanks for joining me today.
Thank you, Michelle. Pleased to be here.
Great. Well, let me take the folks on the line through our agenda on the next slide. I'm just going to give you a real super quick overview of EPAY. Promise not to take up too much of your time because I know everybody's here to hear Ben. But then Ben is going to go through really the where are we now with the Affordable Care Act, what did we learn in the year 1 reporting, and then what are the next steps to prepare for 2017? What is coming down the road? Talk a little bit about the penalty and appeal process and what we might be seeing this summer as it's finally going to hit all of us, and we're all going to see what that means. And then finally, what does the future hold for Affordable Care Act? And obviously, we all know that's a big crystal ball because it's going to depend a lot on who's going to be elected come November. So I know I'm excited to hear Ben's comments. He's always giving us good information here, but I think you'll also get a lot out of today's discussion. And it's a very, very interesting topic, obviously, near and dear to all of our hearts. Let me tell you just really quickly about EPAY Systems. You'll see on the next slide a little bit about what we're all about. We are a Chicago-based firm. We specialize in the human capital management space. Now, what does that mean? That means we deliver a software and services platform to our clients covering applicant tracking and recruiting, onboarding, HR, benefits administration, time and labor management, payroll, and performance management. So that whole stack from hiring or pre-hire actually all the way through to retire. Now, we are a SaaS-based firm, have always delivered SaaS-based solutions to our clients. And the one area that we really like to focus in are employers that have hard-to-manage hourly workers. We do serve the whole salary and hourly base, but our expertise really is in that hourly workforce, that distributed labor, where you're going to have employees that might be pretty hard to track, hard to monitor. They might be moving from site to site or have multiple customers they're working for. That tends to make workforce management a little bit difficult. But that's the type of customers we love to serve. In fact, we have our solutions at 75,000 work sites across North America and around the world today, serving that hourly workforce. We're an industry leader here, providing a very flexible, cloud-based time and labor management system, which is at the core of our whole offering. But we believe workforce management really is the key to controlling your costs and managing your compliance and getting things and having visibility and getting things under control. Of course, though, you need to be able to have that whole stack from beginning to end, and so we do offer solutions for, again, the applicant tracking, HR, benefits, payroll, and so on. For our whole system, our whole solution, we offer a premium customer care support model. Everybody that is an EPAY client gets 24/7 support. Everybody gets premium support, no matter what your question is. And it's because of this support model and this particular care we put on our clients at the heart of everything we do day in and day out, we are proud of our 99% customer retention. So that's a little bit about EPAY in the human capital management space and some of the solutions we offer. At the end, I'm going to tell you a little bit more, but I'm now going to turn it over to Ben. Ben?
Thank you very much, Michelle. And like I said, I'm happy to be here, and thanks to folks from EPAY for asking me to come out and talk about this always timely topic, the Affordable Care Act. And I'm sure now, 6 years in, you're all kind of ready to just lay down on the floor and cry. But we're not done yet. We're getting close, although I think that we're going to have continued challenges for years to come under the Affordable Care Act. But the good news is that the vast majority of the law has been implemented, so maybe the worst is behind us. That said, we're approaching a key deadline coming up in the next couple of weeks that is going to impact, I would imagine, a number of folks on the call. So I think it's important to understand where things stand, where we stand in the time frame of the entire scope of the law, and also what you need to be thinking about in the next month, in the next 6 months, and in the next 5 years, I guess. So I apologize. Every time you speak on this topic, you've got a range of background in terms of what the law might entail or what it requires, and it's always hard to hit the sweet spot in terms of giving too much or too little information. So I'm going to start out with a very brief, high-level background overview of the employer mandate and what it requires and some of the reporting obligations, but then we'll jump into the more substantive, next steps, future considerations, and so on. Those folks on the phone likely have some familiarity with the employer mandate, which went into effect beginning January 1, 2015. The law applies to applicable large employers, as they're called, which means generally an employer with 50 or more full-time equivalent employees. Big key there is that when you're making that count, when you're making the determination of how many employees you have, you must consider related employers. So if you have a lady who owns 2 different businesses, both of those 100%, both of those businesses would be aggregated for those purposes. That's one example. Typically, you've got the corporate family tree where you've got the parent and subsidiaries. Clearly, the subsidiaries that are wholly owned by the parent would all roll up to the top. Unfortunately, the control group rules are dense and complex, and we could devote a 2-hour webinar to those rules alone. So I won't linger there, but just know that the employer mandate would apply if you have 50 or more full-time equivalent employees. Now, I know one of the responses we quite often get when we say that is, well, wait, I thought this year there was an exemption and it only applies to people with 100 or more full-time equivalent employees. That's true and it isn't true all at the same time. An applicable large employer is an applicable large employer. 50 or more, you have to do something this year. The only distinction between 50 and 100 is how severe the penalties might be if you do nothing at all. We'll talk about that. So generally, if you're in a large employer, you're obligated to offer minimum essential, affordable, minimum value coverage to anybody you deem to be a full-time employee, which is generally someone working 30 or more hours a week. Otherwise, you could face a penalty. The penalty would apply if you fail to offer coverage to at least 95% of your full-time employees, although for 2015, the first year of applicability, they loosen that standard, and as long as you hit the 70% threshold, you'll avoid the worst of the penalties. To be clear, that doesn't mean you can pick 30% of your full-time population and say, we're not going to offer you coverage. You can still face a penalty if you miss even a single full-time employee. The penalty just gets much worse if you meet that threshold, either 70% in 2015 or 95% in 2016. Now let me pause for a moment there before elaborating on that a little bit and talk about what we see happening or playing out in the marketplace right now. I think a lot of people are feeling fairly confident coming out of year one. And the reason they are feeling fairly confident is because they've received no indication that they're going to face any liability whatsoever under the law. And you really see two schools of thought here. The first school of thought is, well, the IRS isn't going to enforce these penalties. Nobody can figure out this rule anyway, so we don't need to worry about it. They'll start enforcing somewhere down the road, but we don't have to worry about it right now. I wouldn't rely on that. In fact, we talked to the IRS, and they said, well, look, we don't view this as a revenue raiser. In other words, we're not going to go audit every employer in America and determine whether they offered coverage, and if they didn't, assess a penalty against them. That said, the IRS has a lot of information flowing into them over the next really 30 days. And that information is coming from a variety of sources. Some of them will be employers reporting whether they offered coverage. So if you've self-reported that you offered no coverage, you better believe the IRS is going to assess a penalty in that circumstance. The second, which is totally outside of your control as an employer, is reports coming from the exchanges. And those reports will tell the IRS whether any of your employees received coverage on the exchanges and whether they were offered coverage by you, their employer. You know, again, in that circumstance, if there is that representation from the employer, or I'm sorry, from the employee, and there's no representation to the contrary by you, the employer, again, you better believe the IRS is going to assess a penalty in that circumstance. The reason why is because there are real dollars on the table here. When someone goes to the exchange and receives a tax credit, if they were not, if they go to the exchange to buy coverage and they were not offered coverage by their employer, they can obtain a very valuable subsidy from the government to help offset the cost of coverage. That subsidy can easily run in the $10,000+ range. So if the government is paying out $10,000 here, $20,000 there, $8,000 here, there needs to be some means of offsetting that revenue outflow. And while it's not fully covering that revenue outflow, the employer mandate is one of those avenues. So, you know, if you didn't offer coverage and the government paid out money to help somebody get coverage, you better believe they're going to come after you to help recoup against some of those losses. So that's, you know, the first school of thought. The second school of thought is, I think the IRS is going to enforce this, but I haven't heard anything from anywhere yet, so I think I must have done everything right. That's also not something you should hang your hat on, and the reason why is because the time hasn't arisen when you would hear something to the contrary. So what was supposed to happen, and we'll talk about this a lot more later, is that when somebody enrolled in the exchanges, you were supposed to get a notice. And then at the end of the tax filing cycle, you're going to get another notice from the IRS saying they're going to assess a penalty. The tax filing cycle hasn't closed yet, so you haven't seen that IRS piece yet. That's coming. And the exchanges are taking a bit of time to mature, and as a result, even though they were supposed to be sending out the notices when people enrolled, most of them are not doing so. So you could very likely have a significant portion of your workforce out on the exchanges receiving a tax credit right now based on a representation, whether true or not, that you did not offer them coverage, and you just have no idea because that day of reckoning has not arrived yet. So again, I don't want the message or the takeaway to be here that we've all done something wrong and we're all in big trouble, because I don't think that's the case at all. If you've done what you're supposed to do, you really should theoretically have no or very little liability here. That said, the fact that you haven't heard anything does not mean that you're in the clear, and we're going to talk about why that's the case. So taking a step back again to the penalties can be severe. So the penalty, it's inflation adjusted, so now it's up to, for 2015, $2,080 multiplied by your number of full-time employees if you fail to hit that 70% or 95% threshold. By 2016, that amount will go up to $2,160 per full-time employee if you don't offer coverage to 95% of your full-timers. So let me pause there and just talk about what that means. Let's say you have identified the full-time employees within your population and you offered them all coverage and you think you're good to go. That said, let's say you missed somebody because they had a spike in hours and you didn't think they were full-time, but they actually are full-time. Or you weren't counting independent contractors or employees of staffing agencies because you don't consider them to be your employees, but a handful of those folks have been working for you for 15 years and have their own office, and they get a birthday cake on their birthday and all this kind of thing. And they think they're your employee, and the IRS would probably agree with them in that circumstance. You get a couple of those here, a couple of those there, you can easily suddenly be in a circumstance where you're offering coverage to what you think is 100% of your employees, but is actually less than 95% of your full-time employees. In that circumstance, even though you believe you have offered coverage to every single full-time employee, you would still be liable for a penalty for of $2,160 multiplied by every single full-time employee. So again, the risks here are material, and it certainly merits a close look, even more so in 2016 when your margin for error shrinks from 30% to 5%, to make sure you're picking up all of the appropriate people. Beyond the scope today, there are some things you can do to address that situation I talked about with independent contractors and staffing agencies. It's a big area of exposure, I think, that people aren't necessarily coming around to yet, but something that certainly merits looking at. Certainly the low-hanging fruit here is looking at the people you know are your employees and making sure that you've properly determined full-time status. There are a couple different ways for doing that, one of which is something called a look-back and stability period method. Again, also beyond the scope of today's discussion, but you want to make sure you have a good process in place for making that determination as well. A lot of people are outsourcing that function to a third-party vendor because, setting up those processes or that platform with those complicated rules internally just doesn't make sense. But there you go. That's the risk. Now, as I mentioned, even if you missed a single individual, oh, by the way, there is a deduction when you're calculating that penalty, but don't get too excited about it. Unless you're a very small employer, it's not going to be that much of a mitigating factor, and even if it is, you're still paying out some pretty significant sums of money. All right, so the employer mandate also requires that the coverage that you offer be affordable and provide minimum value. Affordability is determined based on the premium you are charging to employees. You want to make sure that that is an affordable premium, which means generally the self-only premium, employee portion of the premium, cannot exceed 9.5% of that employee's household income. There are a few safe harbors that exist there as well to ensure that you are beating that threshold even if you don't know household income. Minimum value really looks to the nature of the coverage. How much is the deductible, how many services are covered, what's the copay, co-insurance, things like that. Most major medical coverage will easily meet that minimum value threshold. If you're trying to strip everything possible out of your health plan to make it as cheap as possible for you, that's when you probably need to start asking the question of whether my plan provides minimum value. But if you're offering a standard, PPO, HMO, even a high deductible health plan, which is a pretty low value, most of those should easily clear that 60% threshold. If the coverage is unaffordable, or if the coverage doesn't provide minimum value, you can still face exposure, but it is an employee-specific exposure. And what I mean by that is it's no longer multiplied by your entire population, regardless of who it was affordable for. It's only for those individuals for whom it was unaffordable, or for whom it wasn't minimum value. And it assumes that those individuals went to the exchanges and received a tax credit. If they did not do so, even if the coverage was unaffordable, you would not be penalized for that individual. That penalty is $3,000. Actually, it's starting in 2016. It's $3,240, inflation adjusted, multiplied by the full-time employees who did not receive a tax credit. That amount is still a consequential amount, but you know, it's a little bit more tolerable because it's on an employee by employee basis, which is not quite as significant of an area of exposure. So keep that in mind. You know, you want to make sure it's affordable minimum value, but this risk is a little bit more tolerable than the risk or the penalty that you would otherwise face. So that's the penalty part of the equation. The next piece you want to worry about is the reporting obligation. So the IRS needs a lot of information, I guess, is the key takeaway here. Everything is interrelated starting in 2015, 2016, and what employers do impact employees. You know, individual mandate liability and impacts the availability of a tax credit on the exchange, et cetera. So the way that this all works is there's the employer mandate that says large employers must offer coverage or pay a penalty. There is the individual mandate that says individuals must obtain health insurance coverage or they could face liability. There is the premium tax credit on the exchanges, which you know, is available to people who did not have disqualifying coverage from their employer. What I mean by disqualifying coverage is if your employer has offered you affordable minimum value coverage, you are no longer eligible for a tax credit on the exchanges. You can still get coverage, but because your employer offered you qualifying coverage, that coverage is no longer eligible to be you know, to be subsidized by the federal government. So in order to sync up all three of those requirements, the government needs a lot of information from a lot of different sources. They need information from the employer to tell what they offered and whether it was minimum value and affordable. They need information from anybody who offered health insurance coverage to anybody, you know, insurance carriers, self-funded employers, the government, Medicare, Medicaid, because they need to know who was enrolled in health insurance coverage, because that's relevant for purposes of the individual mandate, because you need coverage to satisfy your obligation, and it's also relevant for purposes of the employer mandate and the tax credits, because you cannot get a tax credit if you had coverage somewhere else. Also, you can't be penalized as an employer if somebody had coverage somewhere else, because they can't get a tax credit if they had coverage somewhere else, and the tax credit is what triggers that liability for you. So there's two sets of reports that come into play here. One is by large employers that are subject to the employer mandate, and there's a mandate that they offer this, you know, provide this information. The second is for anybody who provides minimum essential coverage, which could be employers. If you sponsor a self-funded plan as an employer, you would be the sponsor of that coverage and have that obligation. And that's collectively, the IRS needs that information to flow in from a number of different sources. Generally speaking, that information is provided using one of two sets of reports. One set of reports is known as the 1094 and 1095B series. Those are for people who offered coverage. The other is the 1094 and 1095C series. That is for large employers. If you are a large employer and you had a self-funded plan, you're technically subject to both of these obligations, but the IRS set up the forms in a manner that would allow all that information to accumulate and be reported on one set of forms, the 1094, 1095C. So that's what we're going to focus on today, based on what I presume is the profile of the crowd, the C series. And again, this is all still a bit of a refresher, although the 1095C should have already gone out. 1094C deadline is rapidly approaching. And let me just talk about the deadlines. So the deadlines here mirror those that would apply in the context of the W-2 requirement. So as you're aware, the W-2 is really made up of one of two sets of forms. The W-2 itself is an employee individualized tax statement that says what the employer paid them during the course of that year. And there is one copy that is provided to the employee by the January 31st following the year to which it relates. Another copy that is provided to the IRS by the end of February if you are a paper filer, or by the end of March if you're an electronic filer. Similarly, there's a Form W-3 that is the employer-specific report that aggregates all of the employee-level W-2 data, and that's required to be provided to the IRS at the same time frame as the W-2 is required to be provided to the IRS. That's the original time frame, and that's actually what the time frame will revert to for the 1094, 1095C in future years. For this year, because of the chaos that was, the fourth quarter and the instructions coming out late, et cetera, the IRS passed a global deadline extension. So the deadline for 2015 reporting was to send a report, a 1095-C, to the individuals who were entitled to receive one no later than March 31st. And then you were required to issue a mirror copy of that 1095-C to the IRS, plus a 1094-C, which is similar to that W-3, which bundles all of those forms together, either by the end of May if you're a paper filer, a deadline that just passed 2 days ago. Although if you missed a deadline, just don't just say, well, I'll wait till next year. Get that in as soon as possible. Or if you are an electronic filer, by the end of June. Key threshold there being you're required to file electronically, mandated to file electronically if you're filing more than 250 forms. By the way, if you missed a paper deadline and you're only subject to paper, you only have to file by paper because you have less than 250. You can still file electronically. You're not required. You're not mandated to file on paper. The IRS actually prefers that you file electronically if you can do so. So it's not too late for anyone. Form 1094-C is the one I want to talk about first because that's the upcoming deadline and the one that I think we want to keep an eye on here because this is a complicated form and it needs to go out at the end of this month. I'm just going to hit some highlights here. It's going to be relevant in the context of what we're about to discuss, which is issues we saw people run into in the first year. But you need to understand the forms to talk about problems with the forms that we see people experience. So again, the 1094-C is the form that tells individuals whether they had, it's a report to the IRS telling about that employer, that applicable large employer member. So it's not employee specific, but this is sort of your cover sheet. It's your transmittal sheet that goes on top of all the employee specific 1095-Cs and tells about what that specific employee was offered. This one is of the utmost importance though because there are some real red flags on this form that if you don't check the right box, literally you could be subjected to hundreds of thousands or millions of dollars of penalties. So I don't want to be overly dramatic about the consequences there, but realistically that's the significance of this form because if you don't check the right box, you've provided all the information necessary for the IRS to say, type it into their calculator, yep, they owe $3 million, send them a bill. So the first part is actually the easiest part. This gets, unfortunately, progressively harder as we make our way through the form. The first part is just employer-specific information. Now, one important point here, applicable large employer member. I mentioned earlier during the presentation that large employer status is determined based on a control group basis. So if you have 3 affiliates, all 3 of you are aggregated to see whether you're in excess of the 50 employee threshold that triggers a filing obligation. That is true. That is the extent to which your aggregation is relevant though. In other words, if you have 3 affiliates, then all 4 of the EINs within your corporate family must file their own forms. It's obviously somebody else can file on their behalf, but it needs to be specific to that employer. So you would have 4 sets of 1094-Cs, each of which have the 1095-Cs for the employees within that organization. So that is the first section is just information about you as a specific employer. Then you're getting into some information about how many forms you're sending with this report. Again, that's just for your EIN. You're also reporting whether you're in an aggregated AL group, which means are you in a control group? Do you have affiliated employers that we need to look at as well? And that question is one that you certainly need to figure out for these purposes. There are some forms of transition relief that are permittable. Line 22 indicates the forms of transition relief. I'm not going to talk about that now, and certainly I know we're getting some questions in, and if you have questions about the transition relief, I can address those at the end because I think we will have some time there. But I don't really get excited about the forms of transition relief. The reason why is you still have to do everything, you just have to provide a little bit less information. Most of the organizations that I work with have determined that, they've got some system in place and they're already aggregating the necessary information to complete this report. So they don't get that excited about, not populating a piece of information that they easily have or that their vendor is, fully capable of populating. The one exception to this is the Section 4980H transition relief, item C there on line 22. And I apologize, I know this form's a little small, but to the extent you're multitasking, which I know folks are prone to do during webinars about tax reporting, you can Google this form and pull it up, and you know, it's all out there, slightly larger than what you're looking at here. Section 4980H transition relief is important because it's not reporting transition relief, it's penalty transition relief. In other words, the purpose of that box is not to say, I don't want to provide you with as much information to the IRS. It is to say, look, I didn't do something I was supposed to, but you shouldn't penalize me. So, for instance, that might apply because you are subject to the reporting obligation, but you're not subject to penalties. I mentioned this earlier in the presentation, the 50 versus 100 employee distinction. This is the key. This is where you check the box to say, hey, I'm giving you these reports, but I have less than 100 employees, so you shouldn't penalize me for failure to offer coverage. So again, if you have more than 50 employees, you have to complete the forms, but you can tell the IRS, you know what? I didn't give anybody coverage at all, but I get a get out of jail free card this year because I had less than 100 employees. Now again, to reiterate, that only works if you have less than 100 on a control group basis. So you can't just look in the four corners of your organization. The second page of this form is arguably the most important of them all because, again, as I mentioned, this is where failure to check the right box could trigger millions of dollars of liability depending on the size of your organization. And it's column A really is what we're getting at here, minimum essential coverage offer indicator. You absolutely want to be checking yes, either for all 12 months or for each of these months in this column, because by checking no, you are saying I did not offer coverage to at least 70% of my full-time employees this year, which means multiply $2,080 by all of my full-time employees, which, by the way, I'm providing you in column B, so you have that to do the math. Multiply $2,080 times the number in column B and send me a bill for that amount. So again, I'm not advocating lying on this form, but you know, if you have a month in which you feel that you need to check no because you didn't hit that 70% threshold, you've got some problems. You've got some potential liability there and some exposure. And this is why planning on the front end is important, because you want to avoid that result in subsequent years. Another important point about this page, I guess, is it's important to note that your liability can be fixed or cut off during the year. You can't fix it retroactively, right? If you failed to offer somebody coverage in February of 2015, there's not really a way to, you know, go back in time and re-offer them coverage at that point. But if you didn't offer them coverage in, you know, May of 2016, you can start offering them coverage in June and cut off your liability as of the end of May. So that $2,080 penalty in 2015 or $2,160 in 2016 is actually prorated on a monthly basis, and you can fix it at any point during the year and, you know, shut it off for the remainder of the year. So a very important point there that certainly merits, you know, not resting on your laurels and making sure that you've done everything the way you're supposed to minimize or avoid liability. So again, that's the minimum essential offer indicator. Column B, the number of full-time employees, is very important because that's the number the IRS is going to multiply by if you check no to figure out what your liability should be. Column C, total employee count. We're not really sure of the significance of this number, but the IRS is asking for it, so you have to provide it. That's, you know, without regard to full-time status. But again, you were only required to offer coverage to full-timers. Column D indicates whether you were in a control group for that month, whether you had related affiliated employers. Column E, if you selected the Section 4980H transition relief on the prior page, which again is the one I said was important, you plug a code in there to tell what form of relief you're applying for. So all of the columns on this page are very, very important. Final page of the 1094C is just where you essentially snitch on your related employers to tell the IRS that these people are people you should be looking at as well, because they're also subject to this requirement. Again, I'm not advocating not reporting who is in your control group, because you have to, but just know that everybody you're reporting all your affiliated employers on this page, and everybody listed there should be filing their own 1094C, even if they had less than 50 employees. Even that, we had a situation where it was a corporate affiliate in a totally different line of work. It was a dentistry, and the dentist had 2 employees, but they were still required to go through all this rigmarole and complete this process because they were affiliated with a larger corporate organization. Okay. Form 1095-C is the employee-specific report. This one is equally as important because this is where you create a narrative to the IRS. This is sort of your first shot across the bow, if you will, to say to the IRS, look, we did everything we were supposed to. Here's the reason why we think we shouldn't be penalized, so you should leave us alone. And let me dig in a little bit more specifically. The first section, left-hand and right-hand side, is just information about the employee and information about the employer, you. Second part is of great significance, and that is sort of the narrative on a month-by-month basis throughout the year of whether that employee was offered coverage, and if they were not offered coverage, the reason why. So first, if you report an offer of coverage for all 12 months, generally that means you're in pretty good shape because you did what you were required to do. In certain instances, though, you're not going to have an offer of coverage. By the way, there are codes for each of these rows. So for line 14, the offer of coverage line, there are codes to say, yes, I offered coverage to the employee only, or yes, I offer coverage to the employee and their dependent children and their spouse. Yes, I offer coverage to just the employee and the spouse. No, I didn't offer coverage. A series of different codes that correlate to each imaginable situation there. There are certainly going to be times when you didn't offer coverage and it was justified. For instance, somebody was hired in June, so from January through May, you didn't offer them coverage because you had no idea who they were. You're still required to put a code in for every month if you're on line 14 if you're generating this form at all. So you would report no offer of coverage the first 5 months of the year. That said, that's where line 16 becomes significant. And my position is always, although there are certainly exceptions here, but my position is always you should always use a code on line 16, or at least have in mind that you have a code that applies. Because if you have a report that there's no offer of coverage on line 14 and you don't have a code on line 16, what you're telling the IRS, because you haven't completed the narrative, is that this person was a full-time employee that month, should have been offered coverage, but we didn't offer them coverage. So if they got a tax credit, go ahead and penalize us. So again, if you have a no offer code, there are a number of reasons why you might not have an offer of coverage. Those might include that person wasn't an employee that month. That person declined our coverage that month. They waived coverage. That person which by the way, you should have an offer code there in that circumstance as well. So not as big of a deal. That person was a part-time employee and didn't qualify as a full-time employee that month. A number of different things that might justify not having that offer of coverage for that month. So again, there are a series of codes that correspond to each of those circumstances for line 16. And line 16, if you're looking at 1095-C, is, from my perspective, the most important line of the entire form, because if you have a code there, and if there's some legitimacy to that code, you just didn't throw it up just for the sake of throwing something up, it's your get-out-of-jail-free card. Any code there will exempt you from penalty or liability. Line 15, also significant. That's where you report the cost of coverage. That's the self-only cost of coverage, regardless of what the employee actually enrolled in. That's for the IRS to determine affordability. Certainly don't want to lose sight of that one, but it's a little more straightforward than the other columns. So for the time being, I'll leave it at that. By the way, just to reiterate, though, you're not reporting what the employee paid for coverage in that circumstance, because they might have bought up to the most expensive option in the family coverage level. The only thing the IRS needs to know for purposes of affordability is whether there was a single minimum value affordable option if the employee elected it at the self-only level. So what you're reporting there should, unless you've got different coverage tiers and different payment levels within your organization, that should be the same amount for everybody. Take Seyfarth Shaw, for instance. We have 3 health plan levels, self-only, employee plus 1, and family coverage. But our cheapest level is $30. It's a very low-value, high-deductible health plan, $30 a month for self-only coverage. Regardless, they're out of our 3,000-person company, only 5 of us, I think, are on the high-deductible health plan. But that, regardless, that $30 cost is what's reported for everybody within the organization, because that's what they could have elected had they chosen to do so. Finally, part 3, this is for the individual mandate purposes, has nothing to do with the employer mandate. But if your plan is self-insured or self-funded, meaning you don't have an insurance carrier, you might have a third-party administrator, but you have no insurance carrier, you have to tell the IRS who was enrolled in your coverage and during what months. This is the employee, so you want to include the employee there as well, even though you're talking about them above, because it's different information. And any dependent who also enrolled in that plan would need to be reported on this section. I talked about the codes. These are the offer codes. As you can see, you've got offers that translate to pretty much every imaginable situation. MEC here means minimum essential coverage. That could be any type of health insurance coverage. MV is minimum value coverage, which means it meets a 60% threshold. You know, find the appropriate code and plug it in and go from there. The second page here is the line 16 codes, again, the ones that I think are the most important for these reporting purposes. And these are your get out of jail free cards. These are the explanation or the narrative you're providing the IRS as to why you should not be assessed a penalty for that individual for that month. And as you can see, there are a number of justifications for why that would be the case. They're a part-timer, they weren't employed, they terminated coverage mid-month, terminated employment mid-month and lost coverage. You know, they waived coverage. That's 2F, 2G, and 2H, by the way. It doesn't directly say they waived coverage, but that's essentially what those codes mean is they turned down our coverage, but look, it was affordable using one of these safe harbors, so we shouldn't be penalized. You know, a number of codes there that might justify or get you out of penalty. And I talked about part 3 already. This is it blown up a little bit, but this is the individual mandate piece. Okay, let's talk about penalties, and then we're going to move on to reporting errors and next steps. Penalties here are $250 per missed return. Now recall that you're sending one 1095-C to the employee and one to the IRS. So if you just miss that person entirely, you could actually be paying $500 for that individual. And that is per 1095-C. Then you've also got 1094-C, which if you fail to file that in time, that could be another $250, although that's one for your entire organization, so not as big of exposure there. But these could really start adding up if you don't do it right or if you don't do it timely or whatever the case might be. There is a waiver of the penalties permissible if you made a good faith effort. Making a good faith effort does include trying to figure out the right code but misreporting the code. It does not necessarily include, you know, delayed reporting or failure to report or, you know, just putting down the same code for, you know, we made an offer of coverage to everybody in our organization because you don't want to figure out who you actually did offer coverage to. Those likely would not meet the good faith reporting standard and could subject you to much more significant liability there. All right, and by the way, I know we've got some questions coming in, and I am going to have some time at the end here to work through as many of those as I can. 2017 filing. You got to get ready now. As I mentioned, that margin for error shrinks from 30% to 5%, and your exposure is just through the roof if you don't hit that 95% threshold. So you got to kind of start thinking about it now. And what you got to think about is number 1, reporting, but number 2, are we picking up the right people? As I mentioned earlier, there are a couple different ways to determine full-time status. There's the monthly measurement method, which essentially looks at people month by month. The look-back stability method, which averages hours over a period of time. But either way, you kind of want to figure out what you're going to do and write it down somewhere. The reason why is because you're not required to submit that documentation to the IRS. But number 1, if you're audited, or you know, even if an employee questions that determination, you need to be able to demonstrate to the IRS on appeal, which we'll talk about in a minute, why you made the right decision. And then number 2, if your plan eligibility rules are conditioned on whatever your ACA measurement method is, ERISA requires that you have that piece established in writing. So we're certainly recommending that people document that somewhere in a manner that would comply with ERISA at the very least. Vendor reporting, I mean, you know, vendors can handle reporting, but they can also handle that measurement, right? And they might even be able to crank out a requirements document, essentially, that you could argue serves as your eligibility rules if push comes to shove. So, you know, think about whether you want to hire a vendor to do this. Both, there are two different models there. One is that they'll track the hours and then they'll generate reports. The other is sort of the reporting only model that a lot of vendors have started offering, which is you tell us who's full-time and we'll generate these reports to send to the IRS. And then, if you had a vendor last year, think about how the experience went and consider whether that was a good experience or a bad experience. We've certainly heard about some bad experiences, and consider whether you want to go with somebody next year who had a better track record. What I'll say is that I didn't see any vendors sail through with no problems whatsoever. Some were worse than others, but it was the first year of applicability. Everything was on a condensed time frame. So, just because your vendor might have had some minor hiccups does not necessarily mean that everybody else had no problems at all. I mentioned the importance of the control group determination. You absolutely need to have that in place, especially if you're maybe part of a control group but you don't know. At the very least, the good faith standard goes away next year, so if you fail to report everybody who's in your control group, you can face some liability in and of itself. Start early, can't emphasize this enough. The primary problems we saw folks run into is that they failed to realize the significance of this process and how much it entails, and waited until the last minute to get up and running. And depending on the size of your population, the process we saw was that vendors were generating reports and sending them to employers and asking them to confirm that they were accurate because, garbage in, garbage out. If the vendors were provided bad data on the front end, their reports were generated based on bad data and they've got bad information. Just did this last week with a client. They sent over the codes that their vendors generated, which they thought were, all correct. And I said, well, look, just based on looking through these codes, you're not even hitting that, 70% threshold. So they fortunately have time now before they send these reports to the IRS to get out corrected reports to employees and make sure they hit that 70% threshold. I already said it, but there's no good faith reporting standard for 2016, so you got to get on it early. There were a lot of common mistakes this year. I'm not going to linger on these, but these were the problem areas that we saw. If you have employees who are in a multi-employer union plan, reporting is complicated for that group. You want to make sure you get it right. If you have affiliated employers and you had an employee who bounced around and performed services for multiple employers within the organization, there are some complicated rules for making sure you're properly capturing that person's hours and who must report for that in person. Waivers of coverage, making sure that you're capturing the process for reporting waivers, so that and that you have got a system in place to demonstrate that you did offer coverage for that individual. Proper reporting for a full month versus a partial month of coverage. There are some places on this form where you reported it as being an offer of coverage if they were covered the entire month. Other places where you reported them as being enrolled if they only enrolled a single day of the month. So you want to make sure you've got that piece set up right. The list goes on and on. I want to talk about the appeals, and I want to leave some time for questions, so I'm not going to linger here, but other problem areas we saw was COBRA reporting, Part 3 reporting of the employee, line 14 reporting, line 14 and 15, frankly, reporting, incorrectly reporting what the employee enrolled in rather than what they were offered, which can create some liability for you. No accommodation of the monthly measurement method, which is an alternative that not a lot of people used, but some certainly did. Big one here is that if an employee is in a stability period, the look-back stability period method for determining full-time status, and they reduce to part-time status, that doesn't mean you can drop coverage immediately. A big area of liability that I think a lot of people are doing wrong. If you're using the look-back stability period, the default rule, although there are exceptions, is that person gets coverage for the entirety of the stability period regardless of their hours of work. All right, so let's talk about the appeals process briefly. And I'm going to talk about the Cadillac Tax just very briefly, and then we'll jump into some of the questions. So the next question people always ask is what happens next? So the way that the process is supposed to work is that at the beginning of the year, so the open enrollment for the exchanges leading up to January, the person has to make a decision. Am I going to get coverage through my employer or am I going to go to the exchanges? If their employer didn't offer them coverage, the likelihood is that they will go to the exchanges. At that time, the exchange is supposed to generate a notice that is provided to you as the employer sometime at the end of the first quarter of the calendar year, so by March. that hasn't happened, but it's going to start happening, and frankly, you're going to start receiving those notices soon. We're seeing that kind of trickle out, but you're going to start receiving those notices soon. At that time, you have the opportunity to appeal that determination that the employee said they weren't offered coverage and they were entitled to a tax credit. Number of circumstances might lead to that. You know, the employee just might have misunderstood, or they might just have misrepresented, or whatever the case might be. Legally, you're not obligated to appeal at that time, and there's no liability for failure to appeal at that time. You will have another bite at the apple. That second bite at the apple comes much later. So that year goes on, it closes the following year. So let's say we're talking about the 2015 calendar year. Now in January of 2016, January, February, March, you're sending reports to the IRS saying, here's who I offered coverage to. The IRS is going to get all of those reports by the end of June of 2016, so by the end of this month. They will then take the reports they receive from employers, take the reports they receive from the exchanges, and sync the two up and say, hey, this guy said he got a tax credit and said he didn't get a coverage from the employer. Hey, the employer says they didn't offer them coverage. We think there should be a penalty. Or he says he didn't get an offer. The employer says they did get an offer. Something's wrong here. Let's adjudicate this. That's the time when you absolutely must appeal if you think you're right, because otherwise the penalty stands and you pay the penalty. So you do have two bites at the apple, one very early in the process and one much later in the process. There is a form that you can use to appeal. There's some very unfriendly language. You can see at the top here, tell us why you're essentially ruining this employee's life by appealing his eligibility for the tax credit through the exchanges. Don't let that dissuade you. Because you might actually be helping them. I want to talk about the pros and cons of appealing, and those are pretty straightforward. First, you know, you're talking about sort of roughly a year difference, a year plus difference between the first opportunity to appeal and the second opportunity to appeal. As I mentioned earlier during the presentation, you can cut off your liability mid-year if you did something wrong and you fix it for the rest of the year. So, you know, you might want to appeal because you need to figure out whether you, you know, offer that coverage to the employee in the proper manner. You want to test the merits of whatever, you know, well, we sent it to them electronically, but was that sufficient to offer, et cetera. Test the merits of that argument. And if you did it wrong, fix it. It's also possibly beneficial to the employee because if they think they didn't get an offer of coverage and they're receiving, let's say, a $10,000 subsidy through the exchanges, and they're wrong, they have to pay that $10,000 back. And by the way, that didn't go into their pocket. That went straight to the insurance company. So you're almost doing them a favor if they think they didn't get an offer of coverage, but they did, and you know you're fixing it for them now, you know, rather than waiting until next year when they are just continuing to get money that they're going to have to pay back. The cons of appealing at the exchange level as opposed to the IRS level is that you know, there is no financial impact there, assuming you went at the IRS level down the road. Also, you know, it could be time consuming. We don't know yet. We don't really know what the process looks like yet and how streamlined it will be. But, you know, I think the pros outweigh the cons here, to be perfectly honest. Final piece I want to talk about, and I'm going to devote a minute or two to it because I don't know that we're ever going to see it come around, is the Cadillac Tax. The Cadillac Tax is the final piece that has yet to have gone into effect for the Affordable Care Act. And this is essentially an excise tax on high-cost, high-value health plans. So you know these rich health plans, everything's covered, no employee premium, no cost sharing at the doctor. If this ever goes into effect, the likelihood is that those will go away because this is a tax that applies on the plan administrator for those types of plans. So take Seyfarth Shaw, for instance. We had a high deductible health plan, a PPO, and an EPO with an increasing level of richness as you go. It's projected that both our EPO and our PPO is going to exceed the Cadillac tax threshold. So the likelihood is that those benefits are going to be scaled back, and our remaining option will be the high deductible health plan. The penalty is, again, I don't want to linger on this because Congress kicked the can 2 years down the road. They've essentially said, you know, this was supposed to go into effect in 2018. Now it's going to go into effect in 2020. Depending on what happens in the election, we're going to know a lot more, but for the time being, my money is on that this never goes into effect. Both Hillary Clinton and Donald Trump have stated that they are opposed to this tax. Congress has already tried to appeal it and keeps trying to repeal it. So depending on the makeup of the House, the Senate, and the presidency, it seems like the stars are going to align to repeal this entirely. The only X factor there is, what is that makeup of the House, Senate, and the presidency, but also how do you replace the revenue this was supposed to generate, which is always a big ticket item. So, the tax is what it is. You need to start looking at your plan design and determining whether you're going to exceed the thresholds that would trigger this tax. But if you do, or if you're going to start thinking about whether you should make those changes, but you have another 4 years, you might as well wait till January to start making changes to see what happens with the election and what the new president indicates their intent is with respect to this tax. Quick example to show you how it works, but again, I'm not devoting too much brain power to try and worry about this, considering that I don't think it's going to be around in its current form. If it is, it's a problem. I mean, as you can see by this chart, because most people think they are going to trigger it, but just keep that in mind. All right, I know we had a series of questions that came in, so I'm going to try and take a couple before I send you off into the night, and I know the folks from EPAY are going to have a few more things to say as well. Okay, a few questions. Let me try and knock some of these out in the next 3 minutes. We don't get penalties if an employee chooses the exchange in lieu of our insurance program, correct? That is correct. All you have to do is offer qualifying coverage. Now, this presumes that you did offer qualifying affordable coverage, etc. If the employee turns it down and goes to the exchange, there is no liability to you. Penalty amount is $2,000. Is that number being used for calendar year 2015 even though the penalty is indexed? Will the 2160 apply to 2016 calendar year? Good question. 2000 was 2014, even though the penalty was not assessed in 2014. There was a free pass year. 2015 it went up to 2080, and in 2016 it went up to 2160. Which I think we hit later in the presentation. If I offer my full-time employees minimum essential coverage and they go to the exchange, which penalty will we have? If it's minimum essential coverage, you won't have the big penalty, the 2160 multiplied by all full-time employees. You could still experience the smaller penalty for people who go get a tax credit if it's not minimum value or not affordable, which is what you need to work out or look out for. Can I ask my employee population if anyone has purchased insurance through the exchange? You got to be a little careful. The answer is yes, although there are whistleblower provisions that prohibit you from taking adverse employment action against somebody based on accessing a tax credit on the exchanges. So if you ask the question and generate a list of people who receive the tax credits, you better be careful, because if their name is on that list and they get fired for any reason in the future, they might allege that you did it because they went to the exchanges. We're under 250, but would like to file electronically next year. What, when, how do we get the forms and do it? It's not just sending in I would say start early. You probably need to go with a vendor. There is a whole complex IRS system. You're not just emailing them the electronic forms. But the IRS has a whole system, the AIR system, devoted to this. So if you are ambitious and start early enough, that's something you can certainly explore. What can an employer do with employees that went to the exchange and got a subsidy? But we did offer coverage and reported that we did offer coverage. I talked about the appeals process, so I think we're good there. What about a plan year that starts later in January? We didn't dig in here, but there are special exemptions. If you qualify, plan year off calendar year plan year alone doesn't get it for you, but if you qualify, the penalty might not apply until the start of your plan year. We're almost to the top of the hour here, and I know there are a couple more questions. I apologize I didn't get into everything, but I do want to turn it back to the folks from EPAY to take us home.
Thanks, Ben. Wow, that's a lot of information. And I would imagine many of you are overwhelmed. I know that there's a lot of questions that we couldn't even get to, but Ben, thank you again. You certainly delivered a lot of great information.
Of course.
One thing I just want to leave you with before we turn it back over and you guys exit out and go on with your day is that just the EPAY can help. We offer a full solution, a full human capital management solution, but part of that is ACA services that can help manage the things that Ben talked about today. So obviously with time and attendance, we track those hours. They're inherent in our system. For clients that we do payroll with, we have the hours, we have the payroll. Our benefit admin system tracks benefits and when people are eligible and if they're receiving the benefits. So we have all this information inherent in the system, making it very seamless and easy for us to provide these ACA services for you. It's obviously there's multiple paths you can go down to. You can go to a third party where you got to enter all this data in, or you can use a provider like EPAY that has the software and the services that the information's automatically there and the ACA reports and things are automatically generated. So we have the tools that you need, the reporting tools, the analysis tools to be able to look at eligibility, to look at your measurement periods and so on, and get you the reports you need. We also have in our ACA practice, our practice leaders work with our clients one-on-one every month to review that report, the reports, the information, and to make sure they're in compliance and are on the right track. So we don't just give you the reports and let you fly, we stay with you. And on a monthly basis, advise and work with you to make sure you're doing things the way you need to. And then at the end, in January, get the report, the 1094s and 95s filled out for you, give you ample time to review them and do a self-audit, and then, of course, do the electronic filing for you. So that's what I just want to leave you with, again, is our full seamless platform for human capital management along with those ACA services to kind of talk about some of the things that Ben mentioned today that you'll need. With that said, thank you for joining us today. We appreciate it. We're EPAY Systems. We would love to be your human capital management provider. Thank you to Seyfarth Shaw, to Ben Conley for joining us today. Kathy, I'll turn it back over to you.
Great. Thank you, Michelle and Ben, for presenting this very informative webcast today. The archived webcast and slides will be available on the HR.com site within 24 hours. You will receive an email from HR.com with the certification credit information within 1 to 2 business days. EPAY Systems and HR.com do appreciate your feedback, so please take a moment at the very end of the webcast to complete the evaluation survey, which will appear on your screen. This concludes our webcast, and thank you again for joining us, and enjoy the rest of your day.